The underlying context to asset allocation is that all of us want to achieve this goal, this dream of consistently buying low and selling high. Right? This is what we always want to do. Asset allocation, which is probably the most important thing that we provide to our customers. We help them manage their portfolio and do asset allocation so that they are able to navigate periods like this very effectively. So I just want to share a couple of slides again by way of context. And as you can probably guess by now, I love to talk about things spanning multiple decades, because that is the only thing that really gives us perspective when we are looking at dealing with disruptions like we have now. How have we dealt with disruptions like this in the past over the many 20 decades that we've seen? And therefore, what perspective does it give us as we look to manage our wealth over decades in the future? So here are 4 assets that we've mapped all the way from 1981 till now. And let me just quickly explain to you what this means. So what I've done here is to say, if you had $1 lakh to invest in gold or silver or fixed deposits or PPF, and you had done that in 1981, what would that be worth now, right? So if you were to look at gold, then gold, which if you had invested $1 lakh there, would be worth about maybe 26.5 lakhs. Silver, perhaps not as much, more like 15 lakhs. 1 lakh would be worth 15 lakhs now. If you were to look at FD, if you were to look at FDs, fixed deposits, then using a baseline fixed deposit over this entire period, fixed deposits you would have done reasonably well. Your fixed deposits perhaps would have been worth about 27.5 lakhs. And finally, the PPF, which is a very tax efficient way of saving money, that would be worth about 36 or 37 lakhs. And there's a pink line here, which is inflation. The way to think about the pink line is that if you had something that you could buy for $1 lakh in 1981, how much would that cost today, right? And that translates into 1 lakh then would be worth about 13.5 lakhs today. So one fundamental principle that we have when we look at financial planning is that no matter what you do, you need to generate real returns. And by that, what I mean is that you need to do better than inflation. The good news looking at this picture is that all of them have done better than inflation to various extents. Gold, silver, fixed deposits, PPF. The notable absentee in this picture, of course, is the equity markets. The reason I couldn't put them onto the same slide as these other assets is because the axis needed to be different. So I'm going from 0 to 40 lakhs on this picture. If I had to include equities, then I would have to change that axis from 0 to 350 lakhs. Because that is the extent to which investment in the Sensex, suppose you had invested 1 lakh in the Sensex, then that 1 lakh in the Sensex now today in 2020, even after the sharp correction that we've seen, is worth about 170 lakhs. The rest of them kind of cluster at below 50 lakhs. We looked at the PPF and that was about 40 lakhs. So the wealth creation potential that equities have is something that is really surprising. And as you can see from this slide, the Sensex, which if you had invested $1 lakh in 1981, would be worth now about 170 lakhs. Now, I've got another one here, which is called Sensex TR, which is the total return. And by total return, what do I mean? The Sensex doesn't capture things like dividends, whereas the total return includes that. So once you include dividends and other payouts that you get as a result of being a stock investor, then the picture looks even better for equity investing. And your 1 lakh in 1981 is probably worth about 245 to 250 lakhs today. Again, the comparable number for gold, silver, FDs, PPF, all of them were somewhere in the range of 25 to 35 or 40 lakhs. So over a long period of time, over decades, equities is a very powerful wealth creator. So why does anybody invest in anything else? You could ask, right? So I think the picture itself gives you part of that answer, which is that if you were to look at all of these lines are all reasonably steady, reasonably even. Gold, of course, and silver, of course, have their ups and downs, but your normal debt instruments, whether it be FDs or PPF, are slow, steady, gradual wealth creators. Whereas if you look at this picture, it is quite a steep line, but it's got lots of ups and downs. And therefore, investing in equities requires patience, requires a mental aptitude for this kind of volatility. But the price is worth it, right? The price is worth it in that if you were to invest in equities consistently over long periods of time and have the stomach for the ups and downs, then there's no other wealth creator or that is comparable to equities over this time horizon. Now, if we agree that, equities are strong wealth creators, but can really give you stomach churning movements from time to time, then what is a sensible way to invest in equities? And that's where asset allocation gives you such great clarity in knowing what to do when you're investing in equities. If all of us are looking to invest so that we can maximize the wealth that we create, then really what we are trying to do is follow a very basic principle, which is that consistently in everything I do, I want to buy low and I want to sell high, right? The problem when it comes to equities, of course, is knowing when it is low and when it is high. And that is really where asset allocation comes in and is so powerful, because it gives you a framework by which you can consistently do this. So I'm just going to use a simple example to explain how this may work. And it does work because this is what we as financial planners do for our customers, and we've done this over the past 15 years. There is no doubt in our mind that asset allocation is a very powerful framework to use when you're trying to manage money, either for yourself or for a client. So let's consider this example. Let's say you have some money and you've decided that you will maintain a portfolio in which half of your money is invested in growth or shares, let's say, and the other half is in safety or fixed deposits, let's say. This is what you're setting out to do, is that you're going to consistently maintain an asset allocation, which is 50% equity and 50% debt, right? A few more rules here. The first rule is that we will maintain a 50-50 allocation. The second rule is that in case we deviate from our 50-50, we will come back to 50-50 every quarter, right? Those are the two rules. So let's take an example where we apply these rules. Let's say that we were starting to do this in July. We had 20 lakhs to invest, and we decided that we would put 10 lakhs in equities and put the other 10 lakhs in debt. So we've done that. We've selected the right instruments. We've selected the right deposits. We've selected the right funds, and we've done this 10 lakhs and 10 lakhs. Now, between July and October, we go through a bull market. And what happens in a bull market? Equity prices go up very sharply. And again, I'm using this to illustrate my point. 50% increase or 55% increase in the portfolio on equities. Your equities are now worth 15.5 lakhs. Debt continues to keep growing slowly and steadily. So let's say 10 lakhs has now become 10.5 lakhs. Our overall objective here is a 50-50 portfolio where we want 50% in equity, 50% in debt. So what we would do in this case is to sell equities worth 2.5 lakhs and use that money to buy fixed deposits worth 2.5 lakhs, as a result of which we've come back to a 50-50 balance, right? Our overall objective is to have a portfolio that is equally balanced between equity and debt. When we got disrupted from that, we took an action that will help us come back to the same asset allocation of 50-50. Now, let's assume that so once we've done the 50-50, we went into a bear market. And what happens typically in a bear market is that equity is correct. So let's say 13 lakhs became 10.5 lakhs. Meanwhile, debt will continue to grow slowly, steadily. So 13, let's say, has become 13.5. So at this point, you have a portfolio that is worth 24 lakhs. You want to come back to 50-50. So what you would do now is to sell 1.5 lakhs worth of debt and use that to buy equities worth 1.5 lakhs. So you're back in balance at 12 lakhs each. Now, as a mechanical framework, this seems fairly straightforward, right? Every quarter, you look at your portfolio, decide what you have more of, what you have less of, and then you correct the portfolio to come back to balance, right? Mechanically, this is quite straightforward. We can all do this, I hope, right? So as you're looking at the portfolio, you decide what you have more of, what you have less of, and you take the necessary corrective action. But what is interesting is the result of what we have done. When we started out, we said we were not very clear about how to buy low, sell high. What this helps us to do is When the markets went higher, we sold, and when the markets corrected, we bought, right? So what changed here is that there are two things that we changed. First is that we had a clear goal. We said our portfolio has to be 50-50, and in case it goes away from 50-50, we will do whatever is needed to come back to that 50-50. And the second thing that we said is we bring a discipline to how we invest. And our discipline here is that we will not keep on taking decisions all through the year. We won't be reacting to every single thing that happens in the market. We are only going to take corrective actions once a quarter. So two things, the goal and the discipline together helped us to achieve something that otherwise most of us would consider to be quite difficult to do, although highly desirable. And this is really the power of asset allocation. It helps you to create the right investment behavior of buy low, sell high by consistently following this objective of having a goal and having a certain discipline to follow that. I'm glad you all took out the time to engage with us. If you have any further questions, please do drop us a line and we'd be very happy to engage with you as well.